Imagine a corporate entity executing its initial public offering, and within just 18 months, its stock valuation explodes by, well, 67 times.
It is genuinely staggering.
Right. The surge is so violent and so sustained that this hardware manufacturer actually dethrones Toyota. They end a 22-year era of automotive dominance to become the undisputed king of the Japanese market.
Yeah, that's exactly what happened.
Today, we are analyzing exactly how Kioxia pulled this off. Our mission in this deep dive is to provide a strictly objective, highly analytical business briefing focused entirely on Kioxia's unprecedented surge in the global AI memory market.
And we should note, we are drawing the data for this analysis from a comprehensive stack of recent financial market reports, highly detailed technical white papers published by E-Times Japan, and Kioxia's own corporate financial disclosures.
Yeah, there is no speculation here.
Right, only an examination of the documented engineering advancements and the subsequent financial metrics.
Exactly. So, to you, the listener, the objective of this briefing is straightforward. We'll equip you with a clear, impartial understanding of the technological and financial mechanics behind the most significant shift in Japan's economic landscape today.
It really is a historic shift.
It is. So, to understand the extraordinary performance of Kioxia, formerly known as Toshiba Memory, the logical starting point is the underlying product demand. What exactly is driving this revenue on a macro level?
Well, the foundational shift occurring right now is the transition within the artificial intelligence market, from the initial training phase to the current inference phase.
Okay, break that down for us.
Sure. During the training phase, software developers required massive clusters of GPUs paired with high bandwidth memory, or HBM.
Right.
This architecture was designed to process astronomical amounts of data simultaneously, just to teach the core models how to recognize patterns.
But now we're past that.
Exactly. Now, these models are actively being deployed into real-world user-facing applications. This is the inference phase. The AI is no longer learning the textbook. It's taking the test.
And taking that test requires a completely different hardware profile, right?
Yeah.
Specifically relying heavily on enterprise SSDs or eSSDs.
Yes.
Because when we look at modern applications utilizing RAGs retrieval, augmented generation, the AI isn't relying solely on its internal training anymore.
No, not at all.
It is constantly reaching outward to search massive external databases in real time to generate accurate, localized responses.
That mechanism is precisely why the hardware demands have pivoted. Furthermore, we are seeing the rise of agentic AI, which relies intensely on what computer scientists call key-value caches.
Let's clarify that concept for a moment. If a standard AI model processes a prompt and forgets it a moment later, an agentic AI needs to remember the entire context of a complex multi-step task.
Right, it needs memory.
So how does a key-value cache facilitate that, and why does it break the existing hardware limits?
Think of a key-value cache as a massive, continuously updating index at the back of a library. The AI uses this index to store and instantly recall every variable of an ongoing conversation or task.
Okay, I follow.
The problem is that high bandwidth memory attached directly to a GPU is incredibly fast, but it severely lacks physical capacity.
Yeah.
The GPU simply does not have the shelf space to hold this massive, ever-expanding index. Therefore, the system architecture must offload that data storage to high-capacity, low-power enterprise SSDs.
Which Kioxia makes.
Exactly. And Kioxia's internal forecasting reflects this exact structural shift in data center architecture. For the first quarter of 2026, their projected operating profit is expected to reach approximately 1.3 trillion yen.
A 1.3 trillion yen operating profit. That represents a 29-fold increase year over year.
It is massive.
And the corporate disclosures also indicate that Kioxia's production slots for the entirety of 2026 were virtually sold out by February.
Yeah, entirely booked.
So looking at that aggressive forward demand, is this merely another iteration of the boom and bust silicon cycle the semiconductor industry is known for?
What's fascinating here is that global hyperscaler investments have triggered an unprecedented supercycle that actively ignores traditional market periodicity.
How so?
Historically, memory manufacturers would overbuild capacity, market prices would crash due to oversupply, and the cycle would reset every 3 to 4 years.
Right, the classic silicon cycle.
But the hyperscalers, the massive cloud computing providers driving AI infrastructure forward, are locked in an existential technological arms race.
They can't afford to stop.
Exactly. Their capital expenditure on AI infrastructure has created a sustained multi-year demand curve that operates entirely outside of historical models. They are buying capacity years in advance just to ensure they are not left behind.
So the demand is firmly established by the shift to inference. But how does Kioxia physically meet this requirement more effectively than its global competitors?
That comes down to the engineering.
Right, transitioning our focus from market macro trends to microengineering, the physical limits of traditional 2D planar NAND memory are the critical bottleneck that needed to be solved.
Yes. In traditional 2D planar NAND, engineers placed memory cells side by side on a flat silicon wafer.
Just laying them out like a city grid.
Basically. And for years, the strategy to increase storage capacity was simply to shrink the wiring. However, as engineers reduced the wiring width down to 15 nanometers, they collided with fundamental laws of quantum physics.
The physical proximity becomes an issue.
A major issue. At that microscopic scale, the proximity of the memory cells causes severe electron leakage currents. The electrons literally bleed across the barrier from one cell to another.
Which fundamentally degrades the reliability of the reading and writing processes, right? The data just becomes corrupted.
Precisely. It hits a physical wall.
So to bypass those hard physical limits, Kioxia transitioned away from a flat neighborhood of memory cells to a vertical approach, utilizing 3D vertical stacking.
Yes, their 8th generation BiCS flash ash technology.
Right, which stacks memory cells vertically to 218 layers. But looking at the technical white papers, the true technological moat, the reason hyperscalers are favoring them, lies in a manufacturing process called CBA.
CMOS directly bonded to array.
Yes.
CBA represents a paradigm shift in semiconductor fabrication. Previously, the logic CMOS circuit, which acts as the brain controlling the memory and the memory cell array itself, were built sequentially on the exact same silicon wafer.
Okay.
The critical engineering conflict there is that the memory cell array requires a high-temperature annealing process to ensure structural reliability.
So they have to bake it.
They do.
Huh.
But subjecting the delicate logic CMOS circuit to those extreme manufacturing temperatures significantly degrades its performance. It places a hard ceiling on how advanced that logic circuit can actually be.
Okay, let's unpack this. Think of traditional semiconductor manufacturing like trying to install highly sensitive, delicate electrical wiring inside a modern skyscraper.
A good analogy.
But you have to do it while simultaneously baking the building's concrete shell at 1,000 degrees. The ambient heat will inevitably melt and destroy the wiring.
Right, meaning you have to use thicker, less efficient wiring just to survive the construction process.
Exactly. What Kioxia's CBA technology does is fundamentally separate the construction. It is like building the massive concrete shell in one optimized high-heat factory and manufacturing the delicate, highly complex electrical wiring in a completely different, perfectly temperature-controlled factory.
Yes.
Once both components are fully finished, they are brought together and flawlessly fused.
By manufacturing the memory cell array and the logic CMOS circuit on entirely separate silicon wafers, and then utilizing advanced precision bonding techniques to align and fuse them, Kioxia entirely eliminates the thermal degradation of the logic circuit.
That is incredible.
It is. It allows their engineers to maximize the storage density of the memory array while simultaneously pushing the high-speed data transfer capabilities of the CMOS controller to its theoretical maximum.
So in practical terms, this microengineering advantage directly services the high IOPS demands of modern AI inference servers.
Absolutely.
IOPS being input-output operations per second. Essentially, the speed at which the drive can locate and deliver millions of tiny scattered chunks of data to the AI model without lagging.
And that speed is everything for inference.
And the technological supremacy achieved by combining CBA and BiCS flavor has directly translated into historic corporate valuations. We need to evaluate the specific financial data to grasp the scale of this metamorphosis.
Let's look at the numbers.
Recently, Kioxia's market capitalization reached an astonishing 44.3627 trillion yen.
Unbelievable.
In doing so, it briefly surpassed Toyota, which sat at 43.8 trillion yen.
If we connect this to the bigger picture, this event is a profound macroeconomic indicator for the Japanese economy.
How so?
Well, for over 2 decades, the automotive sector has been the undisputed engine of Japanese export power. It served as the benchmark for the country's industrial prowess.
Sure, Toyota was untouchable.
The fact that a semiconductor infrastructure company has overtaken the world's leading automaker signifies a structural transition in global capital allocation. The financial markets are aggressively pricing in the reality that high-speed data storage and retrieval are the foundational commodities of the next industrial era.
Eclipsing traditional physical manufacturing.
Exactly.
The velocity of this valuation shift is equally critical to analyze. Looking at the exact trajectory of the stock From an initial price of 1,440 yen at its December 2024 IPO, it surged to a stock price of 108,600 yen.
Yeah.
That represents a staggering 67 times growth in just a year and a half. Furthermore, to secure supply amidst this global memory scarcity, major tech hyperscalers are actively negotiating long-term agreements, or LTAs, locking in supply for 2027 and 2028.
Those long-term agreements are a critical metric of market anxiety regarding supply chain bottlenecks.
They're essentially hedging against a shortage.
Exactly. Hyperscalers are essentially guaranteeing future revenue streams for Kioxia years in advance. They're willing to do this because the operational risk of lacking inference storage and falling behind in the AI race is vastly greater than the capital cost of overpaying to secure that physical hardware today.
So what does this all mean?
Well,
Because despite the fundamental strength provided by these long-term contracts and the undeniable engineering achievements, the sheer velocity of the 67 times growth requires a rigorous, objective look at the technical trading indicators.
it absolutely does.
When we analyze the current market data, there are severe, measurable warning signs of overheating. The RSI, or Relative Strength Index, currently sits at 82.1674.
And to understand the weight of that metric, we must look at what the Relative Strength Index actually measures. It is a momentum oscillator that measures the speed and magnitude of recent price changes to evaluate overvalued or undervalued conditions.
Right.
In technical analysis, an RSI above 70 traditionally indicates an overbought condition. It suggests the asset's price has risen too far, too fast, and it's statistically due for a downward correction.
So an RSI of 82.1674.
An RSI of 82.1674 for a mega-cap equity of this size is an extreme statistical outlier. It indicates massive institutional and retail momentum, but mathematically, it represents a highly stretched valuation.
Furthermore, the stock is exhibiting a continuous band walk, having decisively broken through the Bollinger Band upper limit of 104,581 yen.
That's a textbook warning sign.
Right. For clarity, Bollinger Bands are plotted at standard deviation levels above and below a simple moving average of the stock's price. When a stock price continually rides or exceeds that upper band, the upper limit of 104,581 yen, it highlights an intense, potentially unsustainable bullish fervor.
Yes.
The price is operating outside the bounds of normal statistical variance. But perhaps the most concerning metric regarding retail vulnerability is the credit margin ratio, which is currently sitting at 15.76.
That margin ratio is a critical vulnerability in the current valuation.
Why is it so dangerous?
A ratio of 15.76 indicates a massive accumulation of leveraged retail buying. Essentially, retail investors are borrowing heavily from their brokerages to purchase Kioxia's stock, anticipating that the price will only continue its upward trajectory.
So it is a 15-to-1 imbalance.
Yes, a 15-to-1 imbalance of leveraged long positions against short positions.
And if a sudden market correction occurs, those brokerages will issue margin calls, demanding that retail investors deposit additional cash collateral to cover the declining value of the stock.
And if they don't have the cash.
If the investors cannot provide that cash, the brokerages will automatically liquidate their shares on the open market. This dynamic historically triggers a cascading effect, where forced automated selling drives the price down further.
Which then triggers the next wave of margin calls at lower price levels.
Exactly.
That is the pivotal analytical tension of this entire briefing. On one hand, the underlying cash flows, the 1.3 trillion yen projected operating profit, and the multi-year long-term agreements represent tangible, unprecedented fundamental business strength.
The foundation is real.
It is. On the other hand, the technical metrics, the RSI of 82.1674, the breach of the 104,581 yen Bollinger upper limit, and the margin ratio of 15.76 clearly illustrate a secondary market driven by psychological euphoria and extreme leverage.
Right.
A reversion to the mean is mathematically probable in the short term, even if the long-term business trajectory of the CBA architecture remains intact.
Now, beyond the daily technical trading metrics and the risks of retail leverage, there are deeper structural and ownership dynamics actively shaping Kioxia's supply side and its future corporate stability.
Yes, governance is key here.
Specifically, we have to examine corporate governance and the recent maneuvers of its major shareholders.
The exit strategy of the primary shareholder is a crucial component of this supply-side analysis. The Bain capital holding has recently been reduced to 14.17%.
Right. Bain Capital led the original private equity consortium that acquired Toshiba Memory during Toshiba's financial crisis years ago.
Exactly. And as a private equity firm, their fiduciary mandate is to eventually exit the position and secure realized returns for their institutional investors.
So they're cashing out.
Taking massive profits at these historic 44 trillion yen valuation levels is standard operating procedure, but it introduces a complex supply dynamic into the open market.
Specifically, this profit-taking acts as a heavy, continuous weight on market supply and demand.
Yes, it does.
When an entity holding billions of dollars in equity begins systematically liquidating portions of its stake, that steady influx of stock supply can suppress upward price movement.
Acting as a ceiling regardless of how much retail buying pressure exists.
Exactly.
This raises an important question. Can the broader institutional market absorb Bain Capital's continued sell-offs without breaking the current bull run?
It's a huge test for the stock.
The sheer volume of shares being dispersed requires immense sustained institutional appetite just to maintain the current stock price of 108,600 yen, let alone push it higher.
This also provides a clear lens to evaluate the impact of shareholder capitalism on the entity itself. We have to contrast Kioxia's current operational agility with its past iteration as a division buried within the massive, slow-moving Toshiba conglomerate.
It's night and day.
When Toshiba faced its severe crisis, the intervention by foreign private equity funds forced a rigid strategy of selection and concentration.
Because under the traditional Japanese conglomerate model, capital was often distributed across dozens of entirely unrelated divisions, some highly profitable, some failing.
Right.
Which inevitably led to inefficient resource allocation and sluggish executive decision-making. By excising the memory division and establishing it as an independent entity driven strictly by shareholder capitalism, Kioxia was forced to concentrate purely on its core competency, NAND flash memory.
Which freed them up.
Yes. This streamlined governance structure is what allowed them to aggressively allocate massive capital directly to research and development, resulting in innovations like the BICS Flash 8th generation and the CBA architecture, without having to navigate a labyrinthine corporate bureaucracy to secure funding.
Additionally, the strategic global partnerships maintaining this independent structure are vital to global hardware supply.
Very true.
Following the separation of Western Digital's memory business into SanDisk, Kioxia and SanDisk have officially extended their collaborative manufacturing operations at the Yokkaichi and Kitakami plants all the way through 2034.
That joint venture extension is a cornerstone of global semiconductor supply chain stability.
Because building these facilities is incredibly expensive.
Developing next-generation fabrication facilities requires capital expenditures measured in the tens of billions of dollars. By sharing that immense financial burden and pooling their proprietary intellectual property, both Kioxia and SanDisk mitigate their individual corporate risk,
while securing the immense physical production scale required to service the hyperscale cloud providers through the end of the next decade.
Exactly.
As we conclude this briefing, it is necessary to summarize the implications of this data impartially and clarify why the macroeconomics of enterprise data centers directly impact you, the listener.
It absolutely affects the average consumer.
The dynamics we have analyzed, Kioxia's absolute pricing power, driven by their CBA technological moat, and the broader global AI memory shortage, do not exist in a vacuum. They directly and severely impact the bill of materials or BEAM costs for standard consumer electronics worldwide.
Because high-capacity enterprise SSDs for AI data centers yield vastly higher profit margins, global manufacturing capacity is actively being prioritized to fulfill those hyperscaler long-term agreements.
Which starves the rest of the market.
Yes, this inherently restricts the physical supply of standard memory available for the consumer electronics market. Consequently, the smartphones, laptops, and personal computers currently in production will likely face immediate and significant retail price hikes.
Because the underlying memory component costs for consumer manufacturers are effectively doubling.
Right. The cost of the AI infrastructure build-out will be passed down the supply chain.
We began this analysis by noting the historic scale of this market shift, driven by the physical transition from 2D NAND to 3D stacked CBA architecture, ultimately resulting in a staggering market capitalization of 44.3627 trillion yen.
An incredible milestone.
But we will leave you with a final, forward-looking proposition to evaluate independently.
If Kioxia's historic 44 trillion yen valuation is entirely built upon solving the physical memory bottleneck for current generative AI inference models, what happens to the value of this hardware infrastructure if the underlying software architecture suddenly changes?
Here's where it gets really interesting. What happens if the next major breakthrough in AI software architecture, perhaps a new algorithmic paradigm that efficiently compresses logic entirely internally, suddenly requires exponentially less physical data retrieval from external enterprise SSDs.
It would upend everything.
Could the massive trillion-yen hardware infrastructure currently being aggressively built, funded, and fought over end up becoming the empty, obsolete digital warehouses of the 2030s? It is a variable that the current 108,600 yen stock price simply cannot possibly forecast.